We're waiting for Mr. Jerome Powell to go ahead and talk. He's super late. He's supposed to start at 8:25. Come on, Mr. Jerome Powell. Playing them crackhead ass games again. That's what he's doing. He's playing them damn games again. Damn right. Better stop playing them crackhead ass games. He's back there doing something back there. Or Trump is probably getting on his ass before he get up on stage. He's probably saying, "Hey, let me hear you say you ain't cutting no rates this month, next month. It's gonna be a rout. It's gonna be a rout." Damn right, let's get this money. Man, listen, man, I've been okay. There you go. About damn time.
I'm here to deliver the 4-minute warning.
4 minutes?
Not really.
Okay.
Let's get started.
Stop playing them games.
Good morning to everyone and welcome to the Federal Reserve Board. I'm very pleased, though not surprised, to see such great interest in the topic of today's conference, the integrated review of the capital framework for large banks. And I want to thank Vice Chair for Supervision Bowman for having the great idea of holding this event at the outset of her term. I'd also like to thank Fed staff for their tireless work in putting the conference together. So today, we'll hear the perspectives of industry veterans, academics, and current and former policymakers who are all well-versed in the operations of large banks and the main pillars of the capital framework. A great benefit of this conference is the chance to consider all elements of the capital framework in concert, rather than look at each in isolation. We need to ensure that all the different pieces of the capital framework work together effectively. Doing so will help maintain a safe, sound, and efficient banking system for the benefit of the people we serve. The U.S. bank capital framework includes risk-based capital requirements, leverage requirements, the surcharge for the largest and most complex banks, and the stress tests. We will discuss the status of each of those elements and the road ahead in a comprehensive manner today. As this audience will know well, we have proposals outstanding or in the works across all 4 areas. Our regulatory capital framework and all banking rules are implemented through supervision, an area where Vice Chair for Supervision Bowman brings deep experience as a former banker and state supervisor. As she has noted, we need to make sure that our supervisory practices focus on the critical areas that determine safety and soundness. We need our large banks to be well capitalized and to manage their key risks well. And we need large banks to be free to compete with one another, with non-bank financial institutions and with banks in other jurisdictions to provide capital and support economic growth. The Fed is a dynamic institution. We're open to hearing new ideas and feedback on how to improve the capital framework for large banks, and I look forward to hearing from today's participants. Thanks again to all of you for joining us today. Thank you.
All right. Thank you so much, Chair Powell. Welcome, everyone. My name is Amol Vaidya. I'm sure I've been inundating your email box with Capital Conference 2025 emails for registration and logistics. I will go over a couple of quick housekeeping things, and we will start the next panel at 9 a.m. As you know, this is a secure building, so our colleagues in law enforcement do ask that you keep your badges on you at all times. If you need to step out for a moment, anyone who you see that does not have a badge on is Federal Reserve staff. They are part of our events team supporting this great event. They're happy to escort you to a coat room or step out to make a phone call. On that point, we do ask that you silence or put your cell phones on vibrate for the duration of this event. And with that said, we will get the next panel started at 9 a.m. Thanks so much.
Good morning. to everyone, and welcome to the Federal Reserve Board. I'm very pleased, though not surprised, to see such great interest in the topic of today's conference, the integrated review of the capital framework for large banks. And I want to thank Vice Chair for Supervision Bowman for having the great idea of holding this event at the outset of her term. I'd also like to thank Fed staff for their tireless work in putting the conference together. So today, we'll hear the perspectives of industry veterans, academics, and current and former policymakers who are all well-versed in the operations of large banks and the main pillars of the capital framework. A great benefit of this conference is the chance to consider all elements of the capital framework in concert, rather than look at each in isolation. We need to ensure that all the different pieces of the capital framework work together effectively. Doing so will help maintain a safe, sound, and efficient banking system for the benefit of the people we serve. The U.S. bank capital framework includes risk-based capital requirements, leverage requirements, the surcharge for the largest and most complex banks, and the stress tests. We will discuss the status of each of those elements and the road ahead in a comprehensive manner today. As this audience will know well, we have proposals outstanding or in the works across all four areas. Our regulatory capital framework and all banking rules are implemented through supervision, an area where Vice Chair for Supervision Bowman brings deep experience as a former banker and state supervisor. As she has noted, we need to make sure that our supervisory practices focus on the critical areas that determine safety and soundness. We need our large banks to be well capitalized and to manage their key risks well. And we need large banks to be free to compete with one another, with non-bank financial institutions and with banks in other jurisdictions to provide capital and support economic growth. The Fed is a dynamic institution. We're open to hearing new ideas and feedback on how to improve the capital framework for large banks, and I look forward to hearing from today's participants. Thanks again to all of you for joining us today. Thank you. Good morning to everyone, and welcome to the Federal Reserve Board. I'm very pleased, though
what the hell's going on?
to see such great interest in the topic.
We gotta
of
wait
today's
or something?
conference, the integrated review of the capital framework for large banks.
Hold up.
And I want to thank Vice Chair for Supervision Bowman.
Hold up. So what the hell going on, man? He ain't talking about now. What's good, everybody? What's good? What's good? What's good? He supposed to be talking. The hell he talking about? Let's get the X right quick. We're gonna see what the hell going on. He ain't talking about none. So I guess we're gonna start at 9 a.m. I think that's what it is. So right now it says Powell's speech ends, but he wasn't saying nothing. That damn Powell. So what we gonna do, we're gonna talk about this until they come back at 9 a.m. That's what they say. That he'll be back. Yeah. He'll be back in 7 minutes. So right now, hold on. Just in, 4.3 trillion. JP Morgan considers offering loans backed by clients' cryptocurrency holdings. Now, for those people out there wondering what the hell is going on, they're saying that, you know, ain't nothing gonna run. This year may be the last year of the bull run or shit like that. Come on, man. I can't believe when you go on any type of media and you see stuff like this, they say stuff like that, and it just doesn't make sense to me. You know what I'm saying? Let's get to it. CNBC just said live on TV that the majority of President Trump's wealth is now in Bitcoin crypto. They could have just said, you know what I'm saying? He's in digital assets.
As I take a look at the shares of Trump Media closing up 3.1% just overnight. But earlier in the session, it shot up as much as 9%. This is after the group said it had accumulated around $2 billion worth of Bitcoin and related assets. Now that stock jumped, helped, of course, take President Trump's stake in the company to nearly $2.3 billion. And that Bitcoin hoard, that is our big number of the day, $2 billion. That translates to about 2/3 of a Trump media's total liquid assets here. And I know that many are talking about potential conflict of interest here. And it is an interesting story given that President Trump, Marty, was once very skeptical of digital currencies and so on. And just think about, think about the regulatory shift that we've had over the last couple of years. I mean,
at the end of the day, what they trying to say is, hey, majority of Trump's wealth is into digital assets, which we already know. We know that already. But does the people outside know that this shift that we will be experiencing, don't you guys see these major institutions? They're like, okay, we got a little bit of Bitcoin, but now it's time to accumulate shit tons of Ethereum. ETH was the last to pump. Dogelon-Mars has not had a major pump since 2021, early 2021. All right. So remember when I told you guys Ethereum 20K? You guys remember that? Let me see in the chat. If you guys are awake right now, do you guys remember when I said Ethereum to 20 bands? You guys can go back in the video. I know I retweeted it. Let me see. But we'll get to that in a little bit. But as you see here, don't you know this is also good for Dogelon-Mars? Dogelon-Mars is a derivative, a commodity, and it's also used for perpetual future trading. So as you guys see here, Coinbase officially launches perpetual futures trading in the United States. So when I see people say, well, hey, Dogelon-Mars is not going to be listed on Coinbase, it's not going to be listed on Binance. I mean, we hold the gem. We've been holding the asset that's been sitting at 6 zeros. We are more valuable than a lot of these other tokens that is going to have a surge of retail investors, not just retail investors, but financial institutions adopting Dogelon-Mars. All right. The Genius Act now law will provide faster and cheaper and more accessible payments while also cementing dollar dominance abroad. This legislation is critical to keeping the future of digital finance anchored in America. Let's go, baby. Blockchain technologies will power the next generation of payments, and the US dollar is coming on chain. Do you know how many trillions will come on chain onto the blockchain family? Please. Come on, man. Come on, fam. Oh, man, it's going to get stupid. It's going to get stupid. I'm still waiting to that man get up on her. Mariah says, prepare for the biggest bull run of this decade, which we will be experiencing. And then someone just bought $165 million worth of Bitcoin. They know what's coming. Man. And as you see here, Coinbase CEO Brian Armstrong says every Fortune 500 company will adopt crypto stable coins. Let's see if this man came back on.
The integrated review of the capital framework for large banks. And I want to thank Vice Chair for Supervision Bowman for having the great idea of holding this event at the outset of her term. I'd also like to thank Fed staff for their tireless work in putting the conference.
Buddy ain't ready.
So today,
type of conference
Okay.
for
All
addressing
right now.
proposals for new rulemaking. So this particular panel has been asked to address changes in the enhanced supplementary leverage ratio, or ESLR, and various other leverage ratio related capital requirements. In the notice of the proposal for rulemaking, the agencies have noted that this virtue of a simple and transparent rule has some unintended adverse consequences, the focus of which in the agency's proposal is the implications for intermediation in the U.S. Treasury market. So what the plan for this panel is that I'm going to ask some questions to the panelists, who I'm going to introduce in a moment, that we have teed up in advance. But in order to keep it lively and engaging, I'm going to get some candid reactions across the panel to each other's comments. And then I'm going to turn it over to you all for questions and answers. So prepare your thoughts and give us some challenging and useful questions, please. So to introduce the panel, to my immediate left is Tiffany Eng. Tiffany is the Global Treasurer of BNY, a financial services company and primary settlement provider for the U.S. Treasury market. Tiffany is a former OCC regulatory attorney. To Tiffany's left is Don Cohn, whom everybody knows, Senior Fellow at Brookings. Don is a former Vice Chair of the Federal Reserve Board and former member of the Financial Policy Committee of the Bank of England. To Don's left is Brian Montaleone. Brian is Head of Global Investment Grade Credit Research and Senior Bank Analyst at Vanguard. Prior to Vanguard, Brian was a top-ranked credit analyst on the sell side, covering global financials for 20 years. And to Brian's left, Hal Scott, Emeritus Professor, Harvard Law School. Hal is also Adjunct Professor at Harvard Kennedy School and Director of the Committee on Capital Markets Regulation. And finally, to the far left is Ben Wiener, partner in Sullivan & Cromwell's Financial Services and Capital Markets Groups. Ben advises banking organizations on regulatory capital, stress testing, resolution planning, and capital market transactions. So I'm going to ask Hal to set us off on first principles. Why do we actually have a leverage ratio rule? And what is the history of this requirement? Do we actually need a leverage ratio rule? And does the backstop rationale for that rule still apply today? Hal?
Thank you, Jerome, and the organizers of this conference. The leverage ratio sets, as you know, a minimum. The leverage ratio sets, as you know, a minimum capital level for bank based on its total value of its assets, regardless of the riskiness of those assets. It operates in parallel with the risk-weighted standards, which set separate minimums that do vary based on riskiness. The theory is that without a risk-insensitive leverage ratio, a bank might be free to expand its balance sheet by acquiring riskless assets without limit. But this is not a realistic model of how banks operate. Banks seek to employ capital to the highest returning activity. So what is the history of this requirement? The basic leverage ratio was not adopted in concert with the other aspects of our capital regime, as part of any integrated whole. It is a vestige of the pre-Basel era. So before Basel, all we had was a leverage requirement. And it was their finding fault with this leverage requirement that actually led us to risk-based capital. So indeed, with the introduction of Basel's risk-weighted approach, the banking agencies intended that risk-weight standards, not the leverage ratio, would take over as the primary determinant of a bank's capital. After the financial crisis, the largest banks were then subjected to the supplementary leverage ratio, and in the case of G-SIBs, the enhanced supplementary leverage ratio, ESLR, which is a more stringent version of the SLR. Importantly, when the banking agencies implemented Basel I's risk-weighted standards in 1989, most commentators argued that the leverage ratio should be dropped because having two separate sets of capital requirements would be duplicative and unnecessary, and the risk-based one was better than the old leverage one. And the agency seriously considered doing away with the leverage ratio, but they ultimately chose to retain it. They were not confident in the accuracy of the novel and untested then risk weightings. And at the time, risk-weighted standards only accounted for credit risk, not market, operational, or interest rate risk, which was also an important part of thinking about bank capital. But we're far along now in the process. Here we are in 2025, and risk-weighted standards have evolved during this period of time. They have since their beginning been supplemented to incorporate market risk and operational risk, and now incorporate complex modeling that did not exist at the time of Basel I. Moreover, interest rate risk is continually monitored by bank examiners as part of the supervisory framework and could be incorporated into risk-based capital if you wanted to do that. We also have several other safeguards in the capital framework that did not exist at that time, like the stress testing regime. So there are strong arguments that the concerns that motivated the retention of the leverage ratio have been mitigated by subsequent enhancements and refinement of the overall capital framework. The leverage ratio is now a frequently binding requirement for the largest institutions, meaning that it requires more capital than the risk-weighted standards. This is inconsistent with the agency's original rationale for retaining the leverage ratio, which was that it would sort of be a backup for the insufficiency of the risk-weighted requirements. Bank capital levels, in conclusion here, are at all-time highs now, well above what Basel and other jurisdictions required. I think we need to step back at this point, which is the whole purpose of this conference, and ask ourselves, with respect to the leverage ratio, not only focus on ESLR, but whether we need it at all. Thank you.
Thanks. Does anyone want to react? What about the issue of intersecting types of capital requirements? Does that cause problems when different banks are subject to different rules at different times? Any views on the panel?
Well, I can offer two observations about the role of the leverage ratio in the broader framework. One is just, I know this conference is primarily focused on large banks, but we do have the community bank leverage ratio for smaller community banks. So there can be benefits in having a leverage ratio for particular institutions. They could have a simpler framework. But I think also the fact that the leverage ratio is itself simple also illustrates one of its potential benefits. I mean, we've seen in stress periods, there's often a focus on simplified metrics. That was certainly the case during the financial crisis. To some extent, it was also the case during 2023. It wasn't necessarily the leverage ratio that was a focus, but there was a focus on things, metrics such as tangible common equity or others that are simple. So the simplicity of the leverage ratio, if it's properly designed and calibrated, could play a complementary role, both for smaller banking organizations if they wanted to have a simpler framework versus the complexity of calculating risk-weighted assets, but also more generally to have a component of the capital framework that sort of the benefit of it is its simplicity, particularly in times of stress.
There's also the issue of assets that turn out to be more risky than they are modeled to be. And this is a backstop for that. So the obvious example from history is AAA subprime mortgage tranches, which weren't really AAA, but were modeled to be AAA and capital held against them, and it was a disaster.
Yes, Brian.
I mean, add when you look at 2023, leverage requirements didn't necessarily catch the buildup in what seemed to be risk-free assets in some banks that ended up having trouble. So I think, and the important thing is, as Ben said, properly calibrated, and it's difficult to perfectly calibrate a risk-based or a leverage requirement in advance. So I think, vigilance and staying on top of, risk is ultimately the key. You can't just rely purely on, either of these. There's constantly new risks emerging. Something like CRTs, certainly growing in use, not very well, not great disclosure around it. It's just, I think staying on top of those risks as they come up is as important as where these are set.
So some support for the backstop principle. Tiffany?
If I can add to that, the leverage ratio is one piece of the puzzle. So banks are managing to capital, interest rate risk, liquidity, and all of those as part of a holistic risk framework is important. I think about stools on a table. Each leg needs to be strong. And so to Brian's point about interest rate risk management, that individually also needs to be a robust leg to keep the entire table stable. But the leverage ratio itself can't overcompensate and make up for any weaknesses in other areas of risk management.
Hal, did you want to react to any of the reactions to your comments?
No.
No? Okay. I sense a degree of alignment on the panel on this. Okay, Tiffany, you're the Treasury market expert. And as I mentioned, there's been a big focus.
All right, so listen up. State Farm was trying to charge me $197 for car insurance. No, thank you. I got a friend who told me about this website.
Yeah, buddy, talking about State Farm and shit. Nobody trying to hear nothing about no State Farm. Get off of that damn thing, man. I have to find another string. Talking about them some damn punk ass State Farm. Nobody give a damn about no damn State Farm. Got me muting stuff.
Like exemptions.
Thank you, Daryl. And let me kick off by thanking Vice Chair Bowman and the Federal Reserve for bringing us together today on this important topic. Let's spend a moment on Treasury market functioning.
Listen, baby
As
girl,
a treasurer, that topic is so critical.
you
These
ain't talking
treasuries
about nothing
liquidity
right now.
management,
We're gonna wait.
collateral
We're gonna wait till
all linked
Mr. Powell
to the
come on in,
Treasury
because
market
like right
being
now
the
they
biggest,
trying to play these
deepest,
little
most liquid bond market in the world.
delusional game
Stands
right
at
down
close to
now.
30
You
trillion
understand
today
me?
and growing.
While they
So
doing that though,
supporting a resilient Treasury market
we're
is
gonna
important for the broader financial system, which we're all invested in. There are two
we're
key
gonna get
tenets
to the
here.
news
One,
right quick
safety,
until
and
he
another,
come on,
liquidity.
because
In terms of
they
safety,
playing them
there are
games
a
right
range of
down now.
enhancements already in flight,
They playing them
including the central
games.
clearing.
So, all right. So as you guys see here, Tom Lee's 2025 forecast for Ethereum. Chairman of BMNR sees ETH at 4,000 by end of July and 10 to 15K by end of year. This is based on CRCL, Circle, multiples, and layer one usage premiums. Let's run it.
So I think in the near term, our technical strategist, Mark Newton, thought we could be seeing 4,000 before the end of the month for Ethereum, but that's not where it peaks.
What's your price target for ETH as we head into the second half of the year?
Our price objectives at Fundstrat. So I wear a couple of hats. I'm the chairman of Bitmine, but I'm also the head of research at Fundstrat. And actually I have a third role, which is the CIO of Fundstrat Capital. But at Fundstrat, Sean Farrell is the head of digital assets research. And he's given me some informal sort of targets. One way he thinks of this is that if we look at Circle and its free cash multiple, which now is like 130 times EBITDA, on an equivalent basis, Ethereum is closer to 15,000. And that makes sense. I think the layer one, as you get into layer one, you should apply a higher multiple to like sort of theoretical usage, because it's the same reason software companies get higher multiples than retailers, right? The more you're getting away from the customer and the more it's pure signal, you apply higher multiples to that business. And so I think in the near term, our technical strategist, Mark Newton, thought we could be seeing 4,000 before the end of the month for Ethereum, but that's not where it peaks. He just thinks that that's the first target. And then I think something, if Sean Farrell's math is correct, then I think 10 to 15,000 actually makes sense too.
By the end of the year?
It could be end of year, it could be sooner. I mean, it just really depends. But and again, that wouldn't be the cap.
He said it could be sooner. It could be sooner. Man, stop playing these damn games, man. It could be sooner. 20K ETH. So with a 20K ETH, that may be coming sooner. Where can you spend dogelon-mars? At the end of the day, we can't go by the old technical analysis. We cannot go by, the old markets, because we have a pro-crypto administration, and not just that, cryptocurrency is mainstream. Type them rockets in the damn chat, man. As you see here, Web3 Wizard says, breaking, Elon just got officially self-certified by crypto.com, which it was self-certified in February of this year. Crypto.com put out an application for dogelon-mars in October of last year. And as you see here, man, stop playing these games. You see October 7, 2024, dogelon-mars cryptocurrency touch bracket contracts. And as you see down below, the exchange has self-certified multiple cryptocurrency contracts in the past, including touch bracket contracts on Bitcoin, Ethereum, Litecoin, Dogecoin, Bitcoin Cash, Shiba Inu, Avalanche, Polkadot, Chainlink. I'm telling you, listen, with this being said, $10 dogelon-mars. This is not no crackhead ass games. $10 dogelon-mars. I'm not worried about the burn. I'm not worried about none of that other extra ass stuff that these other people be talking about. The reason why I say this is we have trillions of dollars that is coming on chain. And these institutions aren't just multi-billion-dollar institutions. Okay? They're multi-trillions. So let's scroll down right quick. As you see here, long-term potential, $706,000 per Ethereum. Ethereum valuation comps relative to other global reserve assets. Ethereum represents an entirely new asset class whose value drivers extend far beyond traditional equity like cash flows. To accurately reflect ETH valuation potential as a global reserve asset, we must consider comparable global reserve assets as a benchmark. Asset number one, oil, that good gas. 85 trillion is the market cap. Rationale, ETH, like oil, is stockpiled as reserves, consumed as fuel for computation, and shares similar scarcity and supply dynamics. Craig, you heard that? Gold, $222 trillion. Rationale, ETH possesses digital gold properties similar to Bitcoin, but with added yield and productivity. 3, global bond market. That's $141 trillion market cap. Ethereum functions as a neutral, non-sovereign collateral asset with the Ethereum ecosystem, similar to how bonds provide foundational collateral and yield across the global financial system. The number 4, global M2, that's $93 trillion. ETH serves as a primary monetary and collateral asset within programmatic finance. So average, 85 trillion. Long-term potential for Ethereum, $706,000 per ETH. Stop playing them crackhead ass games, man. Stop playing them games, man. And they're saying that we ain't bullish. They saying that dogelon-mars can't reach $10. They said, well, CryptoBrown, can we eat 3 zeros first? Can we eat 3 zeros first? Well, yeah, we definitely going to eat them up. It's not about watching the markets, but when you go into these smaller DEX apps and you're seeing like Phantom Wallet, and you're seeing these tokens that are being created with 9 trillion tokens, 1 billion tokens is the max, and then you're seeing other tokens that's being created with a circulating supply of 993 million tokens. And they started out at 5 to 6. No, they don't start out at 6 zeros. They stay around 5 zeros. That's the max. Now all of a sudden they start shooting up. How the hell? How the hell they start shooting up? So this is how we know we hold potential gold. This is how I know that, just like what Elon Musk just opened up a shop yesterday, Tesla Diner in Hollywood, California, they accept Doge. And I believe that they will accept dogelon-mars too. But let's not just keep on throwing that out there, because Mr. Beast Burgers, if you go on Mr. Beast Burgers, they're accepting dogelon-mars as payment. Craig. They accept dogelon-mars as payment, Craig. Y'all ain't down in the rabbit hole. Ethereum is the most battle-tested and widely adopted ledger for tokenized assets. What does that mean, Craig? What does tokenized assets mean, Craig? Craig, listen. We talking about everything on the damn the stock market. So we got Apple. We call Apple X. We got Tesla. We got Amazon. We got MicroStrategy. We got NVIDIA. Let's keep on going, Craig. And if you are seeing these clues of AI and for a tokenized asset, NVIDIA, why do you think they are booming right now? Artificial intelligence. And with that being said, that's what technology. Let's just put it all in one whole. It's dealing with technology. Now, of course, Tesla is dealing with technology as well. Of course, MicroStrategy is dealing with technology as well. You know, but the main factor for NVIDIA is they dealing with artificial intelligence. So with that being said, like, the markets are going to be a lot more higher, and they're going to be on chain onto the crypto market, but they're going to be on chain on the Ethereum blockchain. Stop playing them crackhead ass games, man. On the Ethereum blockchain. Man, let's the bull case for ETH, digital oil store of value, global reserve asset for digital economy, as you guys see right here, man. All of this right here. But you know what? You know what, though? We're going to get to this. We're going to get to this. Ooh, wee. Oh, hold up. Hold the hell up. I was talking too low, 20 bands of Ethereum. 20 bands of Ethereum. Hey, man, stop playing. Hey, Craig, Craig, ETH could touch 80 bands plus as a monetary reserve commodity asset. Hey, it's time for me to get up off this bit. It's time for me to get up off this shit, man. I'm putting the information in front of your face, man. Do you not see that? Do you not see what I just shown you right now? 80 bands? 80 bands plus? We're going to save this for a video later on today. I'm telling you that right damn now. Yeah. We're going to save that. We are going to save that. Undo. We're gonna hold that for another one. But as you see here, man, look, I ain't gonna lie to you. Jerome Powell ain't even saying about nothing. They talking about 2022 supposed to be a big day. July 2020. You get what I'm saying, man? Whatever. $10 trillion Charles Schwab to launch Bitcoin and Ethereum trading services. Why are they doing that now? Hold up.
I think we'll see some real growth.
Hold up.
We also anticipate launching Bitcoin and Ether sometime soon so that our clients have access to that. And we think that'll be an acceleration of our growth, because what we hear from many of our clients are that they have 98% of their wealth here at Schwab, and they might hold 1% or 2% at some digital native firm to hold their crypto. And
I don't think y'all can hear him. He's just speaking too low. But just know a $10 trillion Charles Schwab financial institution is about to launch Bitcoin and Ethereum trading. And as you see here, Starship is real, and it's the first ever rocket fully designed to take us to Mars. Stop playing them games, Craig.
So I'm here. Starship 6 is ready to go. This thing is CGI in real life. Tomorrow's the big day. It's gonna happen. It's crazy. Never gets.
Dang. Hey, Elon, if you watching this, invite me to SpaceX over there in Cape Canaveral so I can definitely see that Starship. I want to touch it. I want to feel it. I want to touch it. I want to feel it. I want to breathe it. You understand me? Yeah. We're going to let that go. As you see, Elon Musk say, a future where we are out there among the planets and stars is so inspiring. Optimists will prepare for the arrival of humans on Mars. Then the first humans to arrive on Mars, the pioneers, will have a difficult task. It will take men and women with an iron will and unwavering faith in the future. Let's play this right quick, Craig. Hold up. We're gonna have to pause that. But that's kind of that's crazy work right there. That's real crazy work right there, man. You know, that's like seeing some sci-fi Star Trek shit, you know. Fox Business says trillions worth of financial advisors are now coming to Bitcoin. What a time to be alive. What a time to be alive.
Trillions of dollars in assets under management, and registered reps all over the country, financial advisors can now put people in Bitcoin. We knew it was going to make it go. Trillions of dollars in assets under management, and registered reps all over the country, financial advisors can now put people in Bitcoin. We knew it was going to make it go up. We knew the Trump administration was basically friendly to crypto. This was such an inevitable move. That's why it's gone higher now. That's probably why it's going to continue to go higher, because Bank of America, for example, the biggest bank, has not yet made that decision, and they are bound to. Trillions of dollars in assets under management.
She's like trillions of dollars. She knows what's going on. She getting kind of, you know, something spicy over there. An advisor for the Bank for International Settlement says the worldwide financial system needs to rewrite its rules. A tokenized future rewrites its rules. So I'm going to explain it like this. So these Wall Street sharks, you know what I'm saying? They are so used to the insider trading, but it's not even insider trading, man. That's like dead weight. That's like old news. Like, we don't give a damn about that. You can do all the insider trading you want on the stock market. You can't do it in the crypto market. We open 24/7. We see what the hell going on. We see what wallets is holding what. Only if you do your research. Only if you do your research. But you know, they're like, you know, these corporate entities, these multi-billionaires are saying, like, man, we're tired of, you know what I'm saying, like, this person just invested 97 cents into a freaking meme coin and he made $10 billion. Where the hell they do that at? So they want to rewrite the rules. Okay. fine and dandy. So if you're so used to making a 5x gain in a share, if you're used to making to at least the max a top 20% gain, 20x on these stocks, they're like, you know what? Let's rewrite this shit. It's gonna be tokenized. If it's going to be tokenized, we should have those gains like what crypto do. It's going to be a crypto. It's going to be a digital asset. So why we can't do that? You understand what I'm saying? So this is what they got going on. Let's keep going. Bitcoin ETF inflows set to explode once financial advisors can recommend Bitcoin ETFs. Inflows could skyrocket with trillions on the line. This shift may trigger Bitcoin's next major leg up.
Thing to remember about these ETF inflows, not just the surge we've seen recently, but since the beginning, because it's been an absolutely phenomenally performing ETF. And this is a very important point that's overlooked. This is being done with the asset managers not allowing their salespeople, their financial advisors, to recommend it. So that's extraordinary. That's like a shoe salesman not being able to recommend Nike, right? So that's going to change at some point. And I'll sort of leave it to your viewers to determine what happens when that thundering herd of brokers can actually pick up the phone and recommend this ETF.
So there's still a thundering herd of brokers.
Thing to remember about these ETF inflows, not just.
You heard them. We're in the beginning, but we're not even close to the end. They say the end could be May 2026. I can say it's forever, Craig. It's game over, Craig. Game over. U.S. Deputy Treasury Secretary Michael Falklander says stablecoin demand will reach trillions. Why is that, Jack?
If it's done on a blockchain, on a distributed ledger blockchain, it could be minutes, if not seconds. And so it's going to enormously hasten the time frame for making payments. It's more secure. It's more private. It's significantly cheaper. And so if indeed this does revolutionize the way that international payments are invoiced and paid, then there should be a flocking to this technology. And if all of that trade, therefore, is even further denominated in stablecoins, then there's going to be demand for the underlying assets, which are Treasury securities. And we could potentially see on the order of trillions of additional demand.
Damn. ETH ETF corporate buys reached 2.1 billion. In just 1 month, corporate treasury snapped up to 600K Ethereum, now holding $5.33 billion in total. Meanwhile, spot ETH ETFs has topped at 5 million Ethereum. July 16 alone saw a record of $726 million inflow, $499 million from BlackRock. Institutions are here, as you guys see. iShares Ethereum, Grayscale Ethereum, Fidelity in the house, Grayscale again, Bitwise, VanEck. VanEck is definitely bullish on Pudgy Penguins, and stop playing these games. Pudgy Penguins and dogelon-mars collab coming soon. Hey, I'm just throwing it out there. There's no word out on this yet. Ain't nobody saying it, but I'm just gonna throw it out there. Because why the hell Pudgy Penguins is all of a sudden moving? Why the hell VanEck is so definitely bullish behind Pudgy Penguins? Make it make sense. Why would Chinsanity come on board and be a host on the dogelon-mars spaces? Make it make sense. Franklin Ethereum, 21 shares, and Invesco Galaxy. And as you see here now, strategic ETH reserves hit 6.44 billion, held by 56 entities. Man, are you guys bullish, man? Are you guys bullish? Now, I'm going to tell you the truth, though, with XRP. You see, Bitcoin, Ethereum, XRP, Cardano, Dogecoin, Chainlink, Avalanche. See, all of these different assets have their own different type of cycle. We're all going to have our own different pump. Have you ever noticed when certain coins are pumping and other coins are not? It doesn't mean that they're not going to pump soon or they're not going to pump. It's just when they're going to start pumping. Everything triggers in a different manner in these assets, in these blockchains. Let's just be specific. In these blockchains, Bitcoin is going to move by their own specific utility of why it's going to move. Ethereum is going to move because of RWAs. You see, that's why the mainstream media has been basically lying or putting that fog in your face and saying, oh, go ahead and get you some Bitcoin. That's an RWA. Okay, we understand that. But understand this, though. They were just saying Bitcoin. Not all these retail investors are smart enough to be like, okay, well, let me just hold it. Let me just go buy a shit ton of Bitcoin. We're all going to have our own different pumps, but we're going to pump so damn hard. We're going to pump so hard that you are going to be like, damn, I don't know if I should sell or not sell. And then when you start selling, you'll be like, damn, should I have sold that much amount of dogelon? But another thing, I want to give a warning to everybody. A big warning, right? Before you guys start liquidating your assets, all right, you are able to cash out 100 bands on these exchanges. But this is the scary part. Like, they know that you hold, and the banks don't know that. The banks know you spend money on crypto, but then when you start to take out 100,000, that causes a flag. And I know we are here for generational wealth, so we're going to go a lot more deeper on that tonight. And let's go over here right quick.
2 years.
And see what the hell
And our
going
minimum
on.
capital requirements
they
are now
talking about.
1.7 times higher than the Basel requirements.
Hold up.
837 billion
Yeah.
versus 473
What the fuck
billion.
is not even running?
Under Basel because
No, I ain't
of our
mute
stress
this.
testing regime.
Hold on,
and gold
guys.
plate.
Hold up.
We gold plate.
Let's do this right quick.
Capital. It merely moves leverage into the background where it always has belonged, and in my view, we could do away with, okay? And if it's in the background, you can further say, why do we need it then? If it's now in the background, it's not binding anybody. Okay, so anyway, I think overall the US banking system is in a very good place today in terms of its actual capital levels.
Hal, you mentioned gold plating. I'd like to get a reaction to something that came up, another topic that came up at dinner last night, which is the implications of the SLR and other regulations on the ability of U.S. banks to compete both with non-bank financial institutions and with international banking institutions. First, is that competitive angle, does it figure in your minds as an important aspect of the rule change? And secondly, is it actually true that U.S. banks have been at or GSIBs have been at a competitive disadvantage because of the capital requirements that we've been discussing?
Gerald, quite frankly, don't know the answer to that, but I would be skeptical. I think there are a lot of other factors that affect competitiveness. I mean, when we originally adopted Basel, it was because of competitiveness concerns with the Japanese banks, right? And we said, we'll get them on an even playing level. They'll have.
All right, so this is what we're gonna do, man.
But then it turns out they have different accounting systems.
We're gonna run through
they have
this later
different
on tonight
subsidies,
because,
they
like,
have different forms of
I know you
regulation
guys
that
aren't
nothing to do
here
with capital.
to hear
So you have
them,
to
you know,
put
riff
all of
raff. I
that
know
into
it's like some
picture.
information
About
that could be useful, but it's not gonna, you know what I'm saying? You guys ain't here for that. Y'all here to hear what the hell Jerome Powell has to damn say.
Certainly, we have
And he's
higher
in the
interest rate
background being
requirements in
scorched.
jurisdictions, although that does not seem
by
to
you
have
know
stopped
who.
our
So I
banks
see in a
from
comment,
against
people better start
regulation.
learning how to use these
Banks
crypto
and
debit
certainly
cards like
other
MetaMask,
financial
still
institutions have significantly
decentralized.
increased their scale
It's
and
a whole
scope
bunch of stuff we're gonna have to
and
speak
their
over tonight, and
regulation, so that might have merit.
it's tricky.
Moderators don't get to vent
And yes, ZB Sebek, yeah, they do got some cool cards. They do, But we all are, you know,
I don't think the UK
going to be wealthy in this damn super cycle. So once again, fam, I'm gonna tap out right quick, man. I don't feel like I'm gonna leave this on. Should I leave it on? Talk to me.
competing very, very well in the international field, and there are.
Y'all talk to me. Should I leave this live on and let them talk until Jerome Powell? Because I gotta go run I gotta stick and move.
There's much less to worry about. We saw that in the U.S. in the March 23 situation where deposits fled.
Oh shit! Look at this shit. I'm gonna have to find another stream right quick.
Small business owner,
There they go with this.
pay work for your business. Pay.
Is this how they doing it now? No, hold on.
The GSIBs were much better capitalized and much less likely to.
They ain't gonna damn get me like that.
Okay.
I'll make one observation, which
Yes,
is
go
that
ahead, Ben.
you receive a lot of questions about the regulatory capital or liquidity treatment about particular transactions or products and things of that nature. And that does clearly illustrate that they're marginal incentives and essentially what the marginal capital cost, liquidity cost does factor in. That's not necessarily contradictory, but I think it does show that that actual marginal effects of regulation do factor into business decisions. And there are differences between US and non-US requirements.
Tiffany, at a global bank.
Well, I was going to re-highlight some of Don's points. One being completely support interest rate risk management. It's a strong pillar. It's an important risk pillar. And as I mentioned, it's an important part of the overall risk management framework for banks. Second, the holistic review, I think, is an important point as well, because we find that, again, managing to a lot of risk measures, making a change to one risk measure is likely going to have another become binding over time and could have the same constraints, let's say, on the Treasury market. So I think that holistic review is also makes a lot of sense.
Terrific. Okay, I think we got a pretty good sense of the views of the panel, and I think it's time to turn to you all. If you have a question, would you raise a hand? I see there are microphones. Would you also please identify yourself and try to keep it to a question, just one.
All right, fam,
if we have a
I'm
second
gonna
round,
go.
we can
Love
come
you
back.
guys. I'm gonna leave
And
this up.
not a
though.
speech, just a
I'm gonna have
question.
my daughter turn it off when they done with this.
My name is Guowei Zhang. I'm with SIFMA. My question is, as you know, currently category 1, 2, 3 banks are subject to 2 leverage ratios. One is supplementary leverage ratio. The other one is tier 1 leverage ratio. And the question is, why do you think 2 ratios, both target leverage, are needed for these banks?
Okay, I'm going to ask anyone that can address that question because I don't want to handle that one. Hal, do you have a thought on that?
I'm not going to defend one of 2 ratios, and I disagree with both of them.
Okay. I'm watching for hands. Yes.
Hi, Sharoni Shai from Morgan Stanley. I actually have a question directly to Don. You mentioned that you think that we should have a countercyclical buffer. You mentioned overlap between different parts of the capital regime. You mentioned that it was something that made sense in the UK, but at the same time, the US has a much different capital regime, inclusive of the CCAR test, for example, which does give you an ability to build capital to be there for stress. And so I'm curious as to why you would want to impair potential use of capital from the banking institutions in a period of stress where they could be using it to lend and still put on an additional countercyclical buffer on top of that. So it's almost as though the concept behind having overlap is not necessarily taken into account from a buffer mentality where you don't necessarily have the CCAR exam in the UK.
Yeah, so I certainly think there's simplification and the two leverage ratios and overlap between things. That's why this is such a great event today, because the authorities can hear views about how these things interact and whatnot. But I do think my counter-cyclical buffer thought, or at least the way we exercised it in the UK, was exactly to free up capital in a stress event. And by lowering by taking out the counter-cyclical part, you enabled banks to use that capital without running into restrictions on dividends and buybacks and that kind of thing. So our view, and I think as I've read the studies that came out of the March 2020 COVID thing, that for countries in Europe that had countercyclical buffers, they found that the ones that released those buffers had better lending experiences than the ones that didn't. So maybe I didn't understand quite your question totally, but the whole point of the countercyclical buffer is to encourage lending in stress situations, or discourage having a constriction of credit add to a stress situation.
Alistair. Oh, sorry. Yes, you. Thank you.
Bill Demchak. I'm
Sorry,
the
Bill,
CEO of
pardon me.
PNC. Just an observation. This entire conversation on leverage ratio and then pointing to the functioning of the Treasury market. What we're actually talking about is the ability of prime brokers to increase their balance sheet in times of stress. So the noise around, hey, banks are just going to go buy more, trade themselves up because they can take more interest rate. We're not going to buy any more treasuries. So we can get duration 100 different ways without going to the Treasury market. We can do it off balance sheet through swaps. What we're simply talking about is that
imagine being able to build anything, for any reason, in any style, at any scale, just by thinking about it. Meet Base 44, a complete AI creation platform made for anyone with an idea and a drive to bring it to life.
because I think our issue ultimately becomes the size of prime brokerage across Wall Street as opposed to what the leverage ratio is.
So Bill, would the support for hedge funds and others through prime brokerage increase in a stress? So I think one risk, isn't it, that this actually enables the hedge funds to become more levered,
yes,
because banks, and now you've got a stress hits and the margins start increasing, and the pressure on the hedge funds, the basis trade blows up even worse.
You're picking your poison, but that is the correct discussion. So banks, since I worked on a primary dealer desk 30 years ago, they don't take down the auctions anymore, right? We used to, we no longer. The hedge funds bid the auctions. The big banks finance the auctions. If you get an off-the-run treasury that won't trade because it's unfinanceable, you get disruption and dislocation. So you want to be able to finance it. You say, all right, well, I want the treasury market to function because we're running the biggest deficit we ever had, and it's likely to grow. So therefore, I need to get capacity to make this thing work. I need to expand primary deal, the prime brokerage, central clearing, a whole bunch of other things to allow that to happen, all of which I'm in favor for. But I'm simply saying that we're consciously choosing to ask banks to finance a larger portion of the principal positions of the players in the treasury markets. That's what this rule is about.
Yes, Pete, a question right here.
Yeah, I have a follow-up actually to Bill's observation.
Could you give your name?
Peter Blostein, PB Investment Partners. So a follow-up to Bill's question is perhaps heretical, which is to ask, are there other rules that should be addressed if we're trying to get more Treasury market liquidity, namely proprietary trading in the Volcker rule. Should banks rebuild relative value fixed income desks that all migrated out of the banks post Dodd-Frank, post Volcker, and that should be the place for Treasury market intermediation rather than hedge funds, as Bill suggests. Just an off-the-run thought. Thank you. I'm curious if any panelists support that view.
Any views, panelists?
Well, I think in the context of looking at and taking a look at regulations overall, it's an important holistic piece of, the discussion today. I do think in the context of, intermediation is one piece of the Treasury market. Certainly that is a very important activity during a period of stress, but to the point of it's a 30 trillion, close to 30 trillion market today, growing. Intermediaries are one player in that market. Buyers and holders across all different banks is something that we need to and should consider to continue to support that market. So that's the kind of broad view, and looking at broadly regulations overall is, I think certainly the leverage ratio is a step in the right direction, but taking that big picture view as part of that holistic discussion that we're having here today as well.
Subjected to market risk capital.
Market risk, interest rate risk management.
Interest rate risk management, right.
The proposal does cite some research, for example, by Falk Breining and Hilary Stein at the Federal Reserve Bank of Boston, showing that those dealers that were relatively more constrained by SLR provided relatively less liquidity to Treasury markets in the March 2020 event. And more recently, a Federal Reserve Board study by Mary Tian and her co-authors showed that those banks that have more headroom under the supplementary leverage ratio provided more financing, to Bill's point, in the Treasury market. So there is some research in support of what you're all saying. Other?
Daryl?
Yes, Hal.
So I understood the question basically was, let's get rid of the Volcker rule so we can have more prop trading that could actually help the Treasury market. It's the implication. Okay. Okay. So, I understood why we did have the Volcker rule. It was kind of a populist measure back at the time when Scott Brown got elected in Massachusetts. So I remember the Senate hearing on this and the Democrats being puzzled about why we were even doing this. If prop trading would help the Treasury market, I would be in favor of re-examining the Volcker rule. But I want to caution everyone as we talk about all these changes, there is legislation to consider here. This is not something that the Fed or other regulators can easily do on their own. A lot of these changes are embedded in statutes, okay? Now, maybe the president can be creative with executive orders in this area, but as we proceed on this line, we have to ask ourselves, how much can the regulators do without legislative change? And that's a big constraint, okay, in this picture.
Just to be clear, in the legislation, the Treasury market is exempted from the Volcker rule, so it doesn't really restrict proprietary trading in the Treasury market. So let's have another question.
Daryl.
That's not true? Treasury securities are not exempted from the Volcker rule? I think they are. Al?
Daryl.
Sorry.
Norbert Michel, Cato. Hi. Sort of an efficiency question along those same lines. If we're worried about specific activities, okay, and if we're worried about source of strength actually being source of strength at the holding company level, why aren't we more worried about the capital at the IDI level as opposed to holding company level?
So let's revisit that. Anyone have a reaction on this issue of capital at the insured depository versus the holding company? Ben, you have your
yeah, I think capital at the insured depository institution level is a relevant consideration, but we're looking at it today from a level that's high based on a leverage requirement that's also uniquely applicable at the GSIB IDI level, which is just not aligned with the general framework that we currently have. And so it is important to balance what's at the holding company, what's at the bank. And as I was expressing earlier, I think this rule would strike a better balance, but that doesn't mean that going lower is forever going to be a better thing. It's that it's necessary to balance all these things. So it's that this rule strikes a better relationship with the broader framework, in my view.
Okay, I'm watching for hands. I'm also watching the time. We have a couple more minutes. Yes, now Al.
Sure. Thank you. Al Moffat, JP Morgan Chase. So there's been a lot of discussion just early about the role of the leverage ratios as it relates to the Treasury market. And one thing I haven't heard from the panel is the effect on deposits. And so one of the things we saw during the periods of QE was that there was significant growth in deposits prior to the Fed rolling out the overnight RRP program. And strikes me that the changes to the leverage ratio may, reshape that into a potential next crisis. And I'm just wondering if the panel has any thoughts on the role of, particularly the value of changing the SLR for the IDI and the consequence on deposits and other low risk activities like that, even if they are put into cash and not 30-year Treasury bonds. Just, maybe that potentially offers flexibility for the Federal Reserve in the size of the RRP program. But welcome any thoughts.
Who has a thought about this? Ben.
I was going to say the economic analysis of the proposal makes very clear that just in the past years and probably over longer periods, the degree of low risk assets, treasuries, reserve bank deposits are much higher now than they've been in historical past. And I think that's important for the ESLR. It's also important for the basic tier 1 leverage ratio. They have 4%, 5% structure in the prompt corrective action framework. It's been around for a very long time. When it first was implemented, I would be very confident that reserve bank balances and treasuries were a much smaller portion of bank balance sheets. Thinking about the overall structure of the capital framework, looking at the evolution of bank balance sheets, the degree of low risk activities that are related to deposit taking, liquidity risk management, I think it's a very important consideration.
Tiffany.
I agree. As you mentioned, Al, heightened cash balances, heightened deposits, particularly in a period of stress, it typically coincides with when also Treasury intermediation is important. But ensuring, which is why we talk about a targeted approach that specifically excludes cash, for example, because banks tend to be that shock absorber of cash and deposits, whether it be in the immediate stress or afterwards as a result of monetary or fiscal policy. And banks having the ability to support that in periods, particularly volatility or stress, is important. And I agree that both supplemental leverage ratio as well as the tier 1 leverage ratio should also focus on that.
Yes, and I think just to reinforce that, making sure the leverage ratio doesn't impede the banking system when the Fed is doing QE and adding to those deposits that you were talking about. And that's at the Bank of England. We exempted deposits at the Bank of England when we wanted to make sure that was. So I think, as I said, I would be opposed to exempting treasuries blanket, but I think thinking about exempting deposits at the Federal Reserve from the denominator, along with the other things, is worth consideration.
And that's a good point, in that the PRA has made that exclusion as well in their leverage ratios, specifically for cash.
If I could, I just have a quick add-on that ought to be part of this discussion, and that's FDIC insurance on size of your balance sheet. They're the only measure still left where you go period end. And so one of the reasons you see repo get very tight at the end of a month is simply because everybody's calculating their balance sheet on period end. If they averaged it, you'd likely get rid of the month end crunches. It seems to be a pretty easy fix.
Good to know. Okay, so we've run our allotted time. I just want to thank the panel for an extremely illuminating discussion.
Good morning.
Lots of back and
everyone,
forth.
and welcome to the Federal Reserve Board. I'm very pleased, though not surprised.
For welders who demand more, Vulcan delivers. With advanced inverter technology, high duty cycles, and precise arc control.
Bowman for having the great idea of holding this event at the outset of her term. I'd also like to thank Fed staff for their tireless work in putting the conference together. So today, we'll hear the perspectives of industry veterans, academics, and current and former policymakers who are all well-versed in the operations of large banks and the main pillars of the capital framework. A great benefit of this conference is the chance to consider all elements of the capital framework in concert, rather than look at each in isolation. We need to ensure that all the different pieces of the capital framework work together effectively. Doing so will help maintain a safe, sound, and efficient banking system for the benefit of the people we serve. The U.S. bank capital framework includes risk-based capital requirements, leverage requirements, the surcharge for the largest and most complex banks, and the stress tests. We will discuss the status of each of those elements and the road ahead in a comprehensive manner today. As this